Hello, everybody, and welcome to the final episode of this series of the Back to Basics videos for the working trader. In our next series, we're going to be looking at some trades we're going to put on and some more general market discussion. But as I mentioned in the beginning of this series, I thought it was important to just go through the basics of some of the stuff we're actually going to be trading so people know what we mean when we say certain things. So in this episode, we're going to talk about contracts for difference. Now, I don't actually trade with contracts for difference a lot. I've got mixed feelings about them. So we might not put that many trades on with contracts for difference, but I think they're still important to understand because I think they are quite often misunderstood. So what's a contract for difference? Well, it's an agreement or a contract with your broker or whoever's providing you the contract for difference to pay the difference in price of a product from the time you open the trade until the time you close the trade. So what this means is you never actually own the underlying asset. Um, so what happens is if you're trading something, an underlying asset that's at £100 and you've gone long on it, you've bought a contract for difference, and it goes up to £105, the broker pays you that difference, the £5. If it goes down £5, you pay your broker £5. Um, so that's an important thing to note is that you can owe the broker money and sometimes more money than you put down as the margin to open the trade. And if you remember from our video on the spread, when you open up a contract for difference, when you buy or sell into the trade, you'll pay a spread to open it. So that's the difference between the price it would cost you to buy or to open the trade, or the price it would cost you to sell or close the trade. And obviously, if you were going short selling it, it would be reversed. But again, it's the same thing. It's essentially what you pay the broker to open that trade. What are the risks and rewards of trading with contracts for difference? So as I mentioned before, you can lose more than the margin used to open the trade. You can lose a lot more, in fact. Um, the flip side of this is, I guess, you have access to bigger profits with smaller initial investments, but access to bigger losses also. So you have to weigh up whether you think the ability to make bigger profits on smaller initial amounts of money is worth the potential losses you can make. You can go long or short on a trade, and I think this is the main reason that if I ever do use these, I will be using it for, is that if you've just got a normal stock account, a normal cash account where you can just buy the stock and not a derivative, you can't go short on that. It's not in retail accounts anyway. So if if it looks like there's a really good short opportunity, I might put a short trade on with a CFD. Another thing that CFDs offer is easier ways of trading with commodities or foreign exchange. Um, but as I said, I don't use them much. They are risky and complicated instruments, and your profits can be amplified, but so can your losses. So here's an example trade just to kind of make it clear what it looks like and what the ticket box looks like if you wanted to open a trade. So this is a chart of Compass Group. They are a British events, food, catering kind of company. As you can see, the buy price here quoted in pennies. For English stocks, the price is quoted in pence, not pounds. So that would be £12.89. And as you can see, we only need to put down a margin that's 1/5 of that. So 20% of that 12.89, which is about £2.58. And so the good thing, as I said, is that if Compass Group stock goes up to 14.89.5, if it goes up about £2, you will have made £2 profit, even though you didn't put down the full £12.89. You only put down £2.58, which I guess the argument for using that would mean it kind of frees up more cash, more opportunity to make other trades and put your money to work elsewhere. What's important to note though is that if the price went down £2, you're liable to pay that whole £2, even though you only put down 2.58. And in fact, if it went down £5, you'd have to pay £5, which again, in that case would be more than the margin you actually put down. So that's really something you should understand and consider when looking at contracts for difference. Anyway, I hope that was useful, and I'm really excited to start the next series when we start looking at some individual trades we might be taking and having some general market discussion. But anyways, I hope you enjoyed this. I hope it's been interesting. Let us know what you think in the comments, and take care. Bye now.